All right, well, I'm going to go ahead and call this meeting to order. Let's start with roll call. John Vischer, member.
David Rader, member. Harvey Lewis, member.
Evan Fox, Casino Investment Management.
Wayne Palladino, Casino Investment Management.
Gregory Williams, staff.
William Johnston, staff.
Brendan Vavrica, Anco Consulting.
Very good. All right, we have agenda before us. Anyone like to make a motion to accept as presented?
So moved.
Do I have a second? First and second, we do have an agenda.
John,
The minutes?
before we get started,
Yeah.
I just wanted to point out we have a new finance director and controller here with us,
Oh, fantastic.
Jennifer Crocker and Sue Wang.
Oh, hello. Well, welcome.
Thank you.
All right, thank you. So we have the minutes from our last meeting. I reviewed them. I have no changes to make. Move adoption. We have a second? All right, we have our minutes approved from the last meeting. All right. I guess we have Pazina we had Silchester listed on the agenda first. We want to go Pazina first?
Silchester had requested that they be allowed to go first for timing
Perfect.
considerations, so
Then let's
I
go
believe
ahead.
we have Farias on the phone, is that correct?
Yes, that's correct. Yes.
Fantastic. Well,
Can everybody hear me?
yeah, we hear you fine. So the floor is yours.
Wonderful. Well, thank you, everybody. This is Farias Parak from Silchester. I've been at the firm for 25 years. I had marketing and client service. I've met many of you over the years. Jenny Bork, my colleague, is here with me as well. I think you've met with her. Jenny and I are both partners of the organization, and thank you again for the opportunity to present. It's been a 19-year relationship with City of Gainesville, and we're appreciative of that. So I think we have about 15 minutes. Is that right, Brendan?
You can take 15 or 20 minutes for the presentation, and there might be some questions after.
Okay, so we'll use the book as a guide, but we'll keep it pretty interactive. I think the committee knows this pretty well. So we'll pause every now and then to see if there are any questions, and happy to take that. But why don't we go ahead and start on page 4, which is the pie chart page there. Just to remind everyone that 80% of our business historically and now continues to be endowments, foundations, and pensions. And on the right is how we've been managing our assets under management. We're managing about $42 billion today. The red bars signify the actual market value of the program since inception. The green bar represents net contributed assets. And everyone might remember that we closed the program to net new business in 2000 when we reached $5 billion by book cost or net contributed assets. And for 12 years, we simply replaced redemptions, which is really how the program just grew through market appreciation. If a client took out $50 million, we'd move $50 million in. But since the beginning of 2013, we have been allowing the dividend yield of the portfolio to flow out of the program by not replacing redemptions in full, as we had been doing in prior years. So each year, we target an outflow of about 4% of AUM. The dividend yield is 4%. 4% of about 40 billion is about 1.6 billion. So since 2013, we've let 10 billion flow out of the program by not replacing redemptions, even though for most of those years we had a waiting list that was close to 8 billion. But that waiting list went away as we approached 2020, and we realized by the middle of 2020 that redemptions were exceeding our targets for the first year ever, since we kind of closed for new business. So we opened up for new business, and we're open today. So we've seen a higher outflow in 2020, 2021 than what we were targeting, which is why we remain open now.
Farias, would you say that outflow is tactical allocation, a rebalancing, or just a move away from international equities?
In 2020, I would say most of those redemptions were a need for liquidity amongst our foundation base that paid out to charities. A lot of endowments needed money. So that was largely what those outflows were. In 2021, it was a little different. We saw asset allocation changes, a lot of funding to private equity. We saw probably clients taking money away from value In fairness, Silchester has been closed for net new business and had a waiting list. That was $8 billion. So any existing client had to go to the bottom of that wait list. So many of our clients let their allocations with us run ahead of targets because they couldn't get back in. So I think some of the redemptions were them paring us back down to target weight. This year, I think we're seeing pension funds who are fully funded, who have done well with maybe U.S. equities in 2020, 2021, sort of reducing their risk-weighted assets. So it's been a host of different reasons.
Thank you.
And it is fair to say that most of the redemptions this year, every year we get some full redemptions, but the majority of redemptions in 2022 have been partial rebalancing versus complete liquidation.
Great, thank you.
But just to maybe give you a little insight just with a figure, and it's considerably high. It was like one of our first years. We had, in 2020, we had $4.8 billion in contributions, and we had $7.3 billion in redemptions. So the numbers are quite high in terms of both contributions and redemptions each year with this volatility. Moving on to page 5, this is everyone at Silchester in our various roles at the firm. The most significant development, I think everybody knows, is our chairman's working hours. Stephen Butt moved his hours to 3 days a week starting in April 2021. That's gone pretty seamlessly. We have been planning for it for over 10 years. Stephen is still very much involved with decision-making, recommendations for the portfolio, voting on the portfolio, writing research. He's just working 3 days a week in the office now instead of 5 days a week as he was. That's the most significant development to mention. But on what I'd like to sort of stress here is that we take alignment very seriously. Everyone on this page has an investment in the program alongside our clients. We very much eat our own cooking. We have close to $1.5 billion of our own money in the funds. We pay the same investment management fees our clients do. So we're in it the same way. On top of that, we require everyone on this page to allocate a minimum of 10% of total comp to Silchester shares every year. So we don't give equity as part of compensation. We ask all of the employees to buy shares in Silchester, and that ties us to each other, but importantly, that's a form of permanent alignment with our clients because we can't sell those shares until we leave. So that is a form of transition planning that we put into place 6 years ago. So on top of the program assets, we are also owner managers, as we think that owners make different decisions in businesses than employees. So everyone on the page is an owner. And there's no one else at the firm, it's just 25 of us worldwide.
Very good, let's go ahead and move on to the portfolio for you.
Sure. Well, should I just, Brendan, touch on the investment philosophy at a high level for about 5 minutes?
Need to review?
We're pretty, after 19 years, I think we have a pretty good understanding of the investment review. So I appreciate the offer, but let's go ahead and proceed. Thank you.
All right, sure. Let's go to page 10. So what we try to do with the investments we put into the portfolio is grow the intrinsic value. And we very much define intrinsic value as the amount of earnings per share, dividends per share, and assets per share that we can get into the portfolio. And we quantify that on the left side of page 11. So those colored lines show you the growth of Silchester's book value, earnings, and dividends since inception. And why this is important to us is we feel ultimately this is the driver of performance over the long term. What you can see there with the colored lines is that book value has been our biggest workhorse. Red line, earnings, has been the most volatile, and the green line has generally tracked that red line. In 2020, many companies, during COVID, posted lower earnings and even losses. We saw that more in the latter part of 2020 as the PE is a 12-month trailing figure. And many companies were looking to conserve cash by foregoing or reducing the dividend. That's why you see the red and the green line coming down. But due to the financial strength of the Silchester portfolio, that was, we saw a nice recovery in 2021 where you can see that red line and the green line both turning and book value continued to increase. In fact, intrinsic value was up 21% in 2021. And we averaged those three colored lines together and call it intrinsic value on the right. So that 12.8% is simply a straight average of those three colored lines on the left. And that correlation between that and performance is shown on page 13. You can see those two lines being more closely correlated pre-2008, but you can see a bit of a turn in the more recent years where the red line is catching up with the black. But that's how we see the relationship is market performance, the red line, tracks intrinsic value over time, which is why our focus is on propelling that black line north with the companies we put into the portfolio. And what we're saying is obviously value hasn't been rewarded in the last several years, and so there is this scope for improvement based upon where our black line is today. Even though last year was a good year, you can see the uptick in performance, there's still a bit to go. On page 12 on the right, what you see with the red X plotted graph is where the Silchester portfolio was trading relative to our average, which is that dark blue line. So what you can see is that we have a very cheap portfolio, and the multiples are at the bottom right. An aggregate PE of 11.4 times, a book value of 0.8 times, and a dividend yield of 4%. And you can see that compared to the averages, which is much cheaper. And so this is on an absolute basis, but what's quite compelling is the relative discount to EFI as well, which we haven't seen that relative discount really since the dot-com bubble. EFI's PE is 15.5 times, EFI's book value is 1.8 times, and EFI's dividend yield is 2.9%. So not only on an absolute but a relative basis, there's a very large discount with our portfolio. And why don't we go to 14? Jenny will make some comments on where we've been finding the opportunity set in the recent period. And this shows you how we're picking up intrinsic value with the rotation from companies on the right to the left. And this is how those three colored lines grow when we trim more expensive PEs and book values and cheaper dividend yields and replace them with cheaper book, cheaper PE, and higher dividend yields. That is each day how we're gaining intrinsic value. We buy and sell about $80 million each day. We're very active in the market, but we don't want to be more than 1/3 of the daily trading volume. We're very incremental buyers and sellers, but active each day. And each day we're sort of trying to tinker with position sizing to gain more intrinsic value in the portfolio. And this is an example of that on page 14.
So to pick up there on page 14, so these are the significant buys and sells in the 6-month period ending end March. And to Frida's point about how we increase intrinsic value, if you look at that aggregate line on the bottom, you can see very clearly with these buys and sells, we're selling stocks with an aggregate price to book of 1.2, an aggregate at the 12-month trailing PE of 12.1, and an aggregate yield of 4.1%, and replacing those names with names that have cheaper aggregate valuations. You see the price to book for the stock spot 1.1, the aggregate PE 10.9, and the aggregate yield 4.5%. So increasing the intrinsic value with this daily rotation. Much of the rotation that we do, the buys and sells, is with names already in the portfolio. So on the left, it is just the names in bold that are new to the portfolio in that 6-month period. On the right, it is just the names in bold that we fully sold out of. The rest of the names represent trims and top-ups. This is a result of the bottom-up process. It's nice when we can step back and kind of tell a story as to what's been happening. When we look at kind of the buys and sells for this 6-month period, we can make a few points. We can note that much of the rotation is within European names. In previous periods, we've had more rotation with some of our Asian names, but with what's happening in Ukraine and the volatility in Europe, there's been more opportunities to do buys and sells of European names. You can also note that we have been trimming our two main energy holdings, Total and Shell, trimming those on the back of higher energy prices. We've also been trimming two defense companies, BAE Systems, the UK defense company, and Leonardo, the Italian defense company, and trimming those on the volatility that's happening in Europe. In terms of what we're buying, it's really a mixed bag. The names in bold represent a number of various countries and sectors. Largan Precision, for example, is a Taiwanese manufacturer of plastic optical lenses. Bayer is the German life science business. Henkel is a German chemical and consumer goods company. Danske Bank is a Danish bank, and Comsys Holdings is a Japanese construction company specializing in telecom and electrical network infrastructure. So very much a mixed bag there. We do, when we're selling, often it is because the name has come out of the cheapest quartile, but with us many times we'll fully sell out of a name, and then you might see us buying back into it in a later period. One other name I want to note here is China Mobile. China Mobile was one of the names on the sanctions list that came out during Trump's presidency. We had to sell out of it by end of May. We did fully sell out of it last month. This page represents through end of March. But I did want to note that we were a forced seller of that name. And we were actually, quite honestly, not so happy to get rid of it because it really, you can see there, cheap price to book, had a nice dividend yield, good free cash flow, but we did get a fully sell out of it as we were required to. Maybe just moving on page 15, these are the top 50 names. We had 141 names in the portfolio as of the end of March. But as you know, we have that long list of names. We can't just run a portfolio with 50 names or 75 names because of our trading style. But we do have a pretty concentrated portfolio. You see here the top 10 names make up about 25%, the top 25 about 44%, and the top 50 names about 66%. The last two pages I will go through are the geographic allocation and the sector allocation, pages 16 and 17. If you look at page 16, the column to the far right, you can see we had about 40% in developed Europe at the end of March, about a third of the portfolio in Japan, 7% in Hong Kong and Singapore, and then we have about 15% in non-EP names. We can have up to 20% in non-EP names per our investment guideline. We do have a name in Canada, IGM Financial, and we have a legacy name in the U.S. It was a UK name, Henderson at one point. It's now Janice Henderson, domiciled in the U.S. So again, that's a bit of a legacy. But 13.5% in what might traditionally be called EM. But if you look at those names there, you can see they really are your more developed of the quote-unquote developing countries. And I mentioned China. We did fully sell out of China Mobile, so the one name we have that's classified as China is Costco Shipping. It's a ports operator. That is traded, though, on the Hong Kong exchange. So that gives us a bit of comfort in terms of the transparency there. And EP classifies that name as China, so we do as well. But our China exposure then is less than the 0.6% indicated here. And I'll just make a quick note on Russia because that comes up kind of given what's going on. We have always screened Russia out. It's never been part of our screening because of the lack of transparency, the lack of rule of law. So we have never looked at Russian companies. No direct investments, obviously no direct investments in Ukraine. We had estimated that about 1% of the total revenue from the entire portfolio came from those areas. So very, very minimal exposure there.
Yeah, I say that you don't, it doesn't look like you're holding anything in Brazil or India. And, you know, in consideration of sort of the BRIC countries, is there a specific reason for that, or you just don't see any companies with value there?
That's right. We did own a Brazilian mining company at one point. You can see this other line on 16. It at times had some allocations there between 2000, really since 1997 all the way until 2015. That was Brazil at one point, a mining business. India, we've done a few research trips to. At one point, we looked at several tech companies. At one point, we looked at several banks. But in the end, the prices were just too high, and so we didn't invest in them. Generally, what you see us is exposed to more of the developed of your EM markets. There are some frontiers, but mostly it's developed of the EM. But we have looked and we have taken trips to both Brazil and to India in the past, but there haven't been too many businesses that we've then decided to invest in, although we've done research on many names in both countries.
Thank you.
And let me just add to relevance that we don't hold cash to speak of. That's always been part of our philosophy. Even during the height of the pandemic, we did feel that over the long term, it's better to be invested in the market. The one final page on portfolio I'll go over specifically is 17, sector allocations. Not a whole lot to say here. I think a lot of this is pretty self-explanatory. There's a lot of numbers on the page, but to the far right, you can see allocations for end of March, which really aren't that different from where they were as of end of December. You can see our allocation to consumer staples is still relatively low compared to where we were earlier in our history. You know, that's for companies like your Unilevers, your Nestle's are housed, and we would like to own those types of companies because of their good quality characteristics, but the PEs have just been very expensive. I did mention briefly how we're trimming our two main energy companies, Total and Royal Dutch Shell. So right now the percentage to energy is even lower than indicated on this page.
I'm curious, because Shell is a pretty sizable holding of yours over the last couple of years. Is that a function of the valuation of Shell? Is it future business prospects that have deteriorated? But what's sort of the rationale for significantly lowering the allocation to Shell in particular?
Well, you can see, one, that energy on 18 has never been very high. Okay. And on 14, page 14 on the right side, you can see that the book value of Shell and Total, frankly, are over 1. Shell's 12-month trailing PE is 15 times, which is high. The look-through PE that we've calculated is closer to 18, 19 times. And the dividend yield is 3.5%, which is fine and covered by the free cash flow, but the valuations have risen. Obviously, energy has been doing better in the market, so we've trimmed that down and prefer to get a sort of indirect exposure in the portfolio through our other names.
Okay, thank you. And then
yes, to your question, it is valuation driven. We generally normalize oil at $50 a barrel. And for many years, as you know, with commodity prices being so volatile, it was significantly higher than that, which is why energy has historically been so low. Then obviously it really dropped and it's kind of gone all over the place. But you can see on 17 that energy line has been very low, and it's really been two companies, Total and Shell.
And I enjoyed your comparison of BMW to Tesla in your presentation, and I'm just maybe you could speak to that, just kind of to reinforces your investment philosophy. But with BMW versus, say, Volkswagen or Mercedes, I'm just kind of curious, why BMW?
Yeah, I'm glad you saw that page. It is a new page we put in. And I mentioned to you the relative discount of our portfolio compared to the market. And this is an example of why the market's been so high. I mean, obviously, we don't have the FANG stocks in the EP market. We like BMW because, look, you can pick it up with a single-digit PE ratio, a nice dividend yield of 7.5%, and a free cash flow yield over 12%. While Tesla PE is soaring through the roof, The free cash flow yield is pretty low. There's no dividend. BMW sold about 2.5 million cars last year, of which 350,000 were electric plus hybrid. They're attractively valued, and there's no evidence to us that BMW is missing out on EV transition. So why would we overpay for a business? And I think, over the years, we've stuck to our knitting. We've obviously underperformed in very volatile markets when growth has been rewarded, but these are the types of stocks that's been rewarded, and why, there's such a now relative discount with our portfolio compared to EV. And not that Tesla's in EV, but again, this is the types of stocks that are generally driving the market.
Another question. I remember Stephen Butch wrote a wonderful article back in 2007, which kind of foreshadowed some of the challenges that we experienced in 2008 and 2009. It was very, very prescient. I'm curious, overall worldview, it's an unfair question, but I'm going to ask it anyways. What's sort of your overall view, maybe from a historical standpoint, value? You mentioned that your portfolio is trading rather inexpensively given your historical measure. Just what is Mr. Butt's viewpoint currently?
Yeah, maybe I'll answer it, but not in the way you may want.
Okay.
Let's performance page to talk about that. So your performance is on page 18.
Right.
Your long-term performance, which is very close to our long-term performance anyway. You came aboard in May of 2003. What we've identified is value does well when a wrong valuation corrects itself, generally when a bubble bursts. But you never know you're in a bubble until you come out of it.
Right.
So, the parallels that we can draw are before you came with us, 98, 99, during the tech bubble where we were invested in the Diageos and Pernod Ricards of the world, while EFI was invested in your Deutsche Telekom's trading at 70, 80 times earnings. And we kept up nicely, but we didn't lead. But when that bubble burst, there was significant outperformance in 2000, 2001, and 2002. And you came aboard in 2003. Again, there were some years that, it was nice absolute performance, but not extraordinary relative until that sort of bubble burst in 2008 when we preserved capital in a much more meaningful way for our clients. And right now, what we're seeing, again, 2019, it was a very growthy environment. We kept up, but we didn't lead. 2020 was COVID, really the height of COVID, where we were down 24% in the first quarter, but we made that all back up by the end of the year. In fact, our intrinsic value in 2020 was flat, and we were flat in terms of performance, so we felt that was fair. While EFI was up 8%, but their intrinsic value was down 14%. So that was a mismatch to us. And last year, we did see a nice sort of, relative and absolute performance, but I don't think that we'd say value has had a comeback still. It's been obviously very difficult and now even more volatile with sort of the war happening. So the last, the month has been quite volatile. We've kept a nice spread with EC, but, we very much during these times stick to our knitting even more closely. This is not the time to stray. So we try to keep our head down and tune out the noise and continue to do what we're doing by sort of positioning the portfolio in cheaper businesses that have quality that we feel will outperform over time. So I think you'd expect the same from us and nothing differently or too drastic of a change, especially when the markets are so volatile.
Bruce, if I could just ask a question, obviously with price to book and price to earnings, you definitely are kind of cheaper, more value oriented. I'm curious why you're showing against the core IFA index and why you would not compare yourself also to the value IFA. If there's just any kind of thought that goes behind that comparison.
I think we decided early, I think if you looked at the long-term history, EV value has been an easier index to beat, frankly. And especially in the early days when our founders were looking at benchmarks, EV value was simply calculated as the bottom 50% of book value, and it felt a rather crude measure of value when we're looking at the 4 primary metrics for value. And so we felt that EC was still a better index, the better of the worst. You don't see actually any index in the whole book except on your performance page or on your statements. Otherwise, we think of our allocations and are, very, on an absolute basis, rather relative to the index, but we still feel EFI is the best of the worst. I mean, many clients ask us why we're not even benchmarked against ACWI since we have that EM exposure. But in our thinking, 80% of the portfolio has to remain in developed markets at all times by our guidelines, so it is mainly a developed market portfolio, so still, we wouldn't use, ACWI, ex-US. So I don't think there's a right or wrong answer, it's just what we felt is the most appropriate of the worst benchmarks.
Thank you.
Any additional question from staff or board members? So I don't see any questions bubbling up. You obviously did a very good job covering the issues. Do you have anything else you'd like to share with us before we close?
I don't think so. I think we've covered the main points, and we'd like to thank you for the support over this past 19 years. It's been a very nice relationship, and I see now that you're meeting in person, so we will see you again next year in person.
Right. First, I have one question regarding some of the internal research that you guys perform, obviously. Is through your website, is that accessible for board members to take a look at and be familiar with, or is that proprietary internal?
We don't put it on our website, Brendan, but I can send you a couple of samples that you can share with board members, and I'll email that to you today.
If there's any significant research that you think might help us, understand, if you could on a relatively systematic basis share that with us, that'd be fantastic. Thank you.
Yeah, I'll send you the ones today. Sadly, we don't change them very often,
Well,
so it would be the same ones I send you by the end of the year.
Okay.
But it's just it's a look at how we look at businesses, what is important to us, how we normalize earnings. You'll understand all of that by looking at the sample I send you, which is actually a company in the portfolio.
fantastic. Thank you very much.
Sure.
All right. Well, again, thanks for the presentation. We appreciate the hard work and diligence and sticking to your knitting for the last 19 years. And again, thank you.
Thank you very much.
Okay. Bye-bye.
Bye.
Okay, before we go to our next presentation with Bazine, anybody need to take a break? If not, let's go ahead and roll in. Gentlemen?
I appreciate it, thank
All
you.
right.
Good to be here with you again.
Well, it's good to see you.
Yeah, it's, it's funny, we were here last year, and then we kind of went through another wave of COVID, and a lot of people were kind of shutting down and not seeing people again, but I think we're kind of getting back to normal.
But before we, I'm just kind of, my own personal
Yeah.
research, how are the airline flights getting into Gainesville? I'm curious.
We flew into Jacksonville,
Okay,
and they were packed.
okay,
But on time.
Fortunately on time,
okay, all right.
but packed.
Okay, very good,
Yeah.
thank you, all right.
And an interesting, I was mentioning this to Evan yesterday, an interesting factoid about New York is you always saw, it's called the black cars, the Escalades, the Suburbans, for business travelers. They're bringing management teams around. I just started to see a resurgence of those, just in the last week or so. So I think that's another sign of things maybe starting to get back to a more normal type of travel schedule. We've been open, 4 days, we're open 4 days a week now.
Okay.
Having people come in 4 days a week. Obviously they can come in, the office is open 5 days. So we've had some, very good attendance and people getting back to the office, so it's gone well.
Great.
But we're very glad to be here, and I just, the first thing I want to say is just thank you. We just passed our 20th anniversary with Gainesville back in October, and this has been just a wonderful relationship, and I just want to thank you again for allowing us to be a partner with you in this endeavor. I just crossed my 20th anniversary with the firm in June, so I've been with you most of this journey, so thank you.
All right, very good.
And Wayne Paladino, I think everyone knows me, head of client service at Pzena, and Evan Fox, portfolio manager on the Pzena small cap value strategy.
So given our familiarity with, you guys, if there's any significant changes firm-wise, you give us a quick update, but
Yeah.
as usual, we like kind of dig into the meat here, so.
Yeah,
appreciate that.
absolutely. Yeah,
Thank you.
I'll take 2 quick minutes on the firm. Nothing dramatic. AUM is at $50.7 billion, very strong on that front. 5 of the last 5 years have been positive net inflows into the firm, and 8 of the last 10. So even during a period where value had been, somewhat challenged, we've been seeing inflows, net inflows into the firm. Strong pipeline, so things are going very well on that front. No changes to the portfolio management team. You've met them all. Evan Fox, John Flynn, Ben Silver. No changes there. We did have some elevations on our governing bodies. So Caroline Kai, who's really more on our international strategies, was appointed to our board of directors, and Jessica Doran, our chief financial officer, was appointed to our executive committee, which is responsible for the day-to-day operations. Couple of portfolio manager transitions on other strategies. So Rich Pizzina kind of gave up the reins on Focus Value, which is our U.S. mid-large, and Dan Baptiste has been with us 6.5 years, has joined that. Rich continues full-time, totally dedicated to the firm, continues on our large cap strategy, mid cap strategy, and the like. This is really just more evolution of the firm. Same thing with John Getz, our other co-chief investment officer, came off of our EM strategy, continues to be co-CIO, continues to be on our global and international strategies. So all things, great things happening there. 8 new partners in the firm as of January 1st. That makes 63 employee owners of the firm, in addition to about a 25% public equity ownership. And we've added a few analysts to the firm over the last 12 months. So we're hitting on all cylinders. And it's been, it's also been, I want to say this with humility, because when everyone's returns are negative, it's hard to, blow a trumpet and say, things are going great for value. But if you look at it, Evan's going to cover some of this information with everyone, is that value has held up better in this environment than growth. And I think there are some very compelling reasons for that, which we've been talking about for a number of years now with regard to valuation spreads and how we're seeing value in the marketplace. And I think what we're seeing now is some normalization of that. We're not all the way there yet. Spreads are still wide, even given what's happened in the markets. So we're still seeing very compelling opportunities for the portfolio. So with that, let me stop, see if there are any questions firm-wise, and then Evan's going to take us through some of that kind of 10,000-foot level view, and then really dive into the portfolio and what's happening.
Just when we mentioned Rich Pizzina, but
Yeah.
so he said, so he's still active in the large cap, and I thought you said
Large
he's
cap.
on the Focus, which is your mid cap.
That's a
product.
mid-small.
So
I'm sorry, mid-large.
Mid-large. So is he still involved with that, or is it just pretty?
He is, because he sits in on all the research
Okay,
reviews,
all right.
and so he's,
All right, fair enough. That's
yeah,
fine.
and there are 3 PMs on that.
Gotcha.
Yeah,
Good, all right.
yep,
Thank you. All right.
great.
Evan?
Evan?
Great. Yeah, I figured to take us through generally how we're thinking about the market high level, go through some portfolio, but just want to check if there's any particular agenda items you'd like for me to touch upon, or go through any questions you have at the end.
Well, we're pretty interactive, so I'm sure you
Perfect.
spark a question, it'll be asked. So thanks.
Perfect. Well, it's certainly been an exciting period, changing through as we've gone from supply chain disruptions, labor shortages, inflation, interest rates, recessionary fears, Ukraine, Russia. A lot of different factors have really come through and impacted companies over the course of the last year. And what's interesting is that this really creates opportunities for us, but doesn't in any way fundamentally change how we think about these businesses or how we work through them, right? Because what's the most important thing about a company? A company exists because it's a leader in some market, especially for small caps, right? When you think of a large cap versus a small cap company, people say, well, small cap companies are going to lose to big cap companies. Well, that's only if you're a small player against a big player in the same market. But so many of the companies that we own, they're leaders in some niche market, whether it's that they have a duopoly of interior molded doors, whether they make 60% of all the ambulances in the US, whether it's that they're one of only 4 companies that make x-ray tubes that are used in the whole world, or whatever it might be. And so these companies, they deal with those challenges, right? And so what I'll talk through a little bit is where the valuation spreads are, and then how some of our companies are dealing with this, and then what we're doing in light of that.
Good.
Really from a high level in terms of where valuation spreads are, if you look on page 10, thanks Wayne, we've talked about this slide probably most of the years that we've met with you. And the way to read this is what we're looking at is the valuation of the cheapest quintile of stocks on price to book versus the most expensive on price to book. What I will say as a reminder is everything we do is we value companies on what we call normalized earnings, which is really a 5-year out cash mid-cycle earnings that the companies should earn. But price to book, obviously we have data going back 50, 60 years. This wouldn't look so different if you use price to earnings or any other metric. And when you're looking at the difference between the most expensive and least expensive, this measured it in standard deviations. So if you look at what happened a year and a half, 2 years ago, we reached 4.5 standard deviations wider than usual of how wide those valuation dispersions are. And so much of that was really that the high end was just getting so incredibly expensive, to a point higher than we even got in the dot-com bubble relative to the valuations of the value stocks. Now over the last 18 months, a lot of that has come in. A lot of that has been the high end really coming in. And I believe this slide goes through the end of March. If we went through the end of May, we're more in the 1.5 to 2 standard deviations. So still a wide level, but the relative performance has been good along there as the market has come to appreciate the defensiveness of some of the value stocks and really the starting point of those valuations relative to the lofty assumptions that you needed to justify some of the more expensive stocks. And so what's really interesting, especially with the disruptions that we've seen over the course in the market overall over the last couple months, is people say, have you had major turnover? Have you been really active? And what I'd say is that the period of, say, February to June of 2020 was probably the most active we've ever been in terms of changing over a number of names, finding a lot of opportunities. A lot of things were falling through the cracks and really becoming deep value opportunities. With the market corrections that we've seen recently, it actually hasn't changed the composition of the first quintile as much as you'd think. We've seen a lot of changes of the most expensive stocks, but the rotation more recently actually has not been as dramatic as you might think relative to looking at the market, especially compared to what we saw a couple years ago. So I think it's helpful just to have that framework that, as Wayne touched on, the difference between value and growth has been pretty stark throughout the course of this year. It's some 1,500 basis points of how value is done relative to growth. Hard to be excited when it's still down a lot, and that's, of course, what everyone's focused on. But we're seeing more of that appreciation for the businesses that earn money, right? Companies that have a real free cash flow yield.
Now, one quick question, just I think for everybody. So when you say value versus deep value, okay, I know deeper is lower than here, but could you kind of statistically explain how you guys define deep value?
Really, when I say value, right, that's the value benchmarks, right? When we think of what makes our value investment, we're looking at only the cheapest quintile, the cheapest 20% of stocks on our price to normalized earnings metric. That's what we've been doing for the 27-year history of the firm, and same process everywhere in the world, wherever we might be.
Thank you for refreshing this.
No, definitely. It's a good question. Now, what's interesting is we're now maybe 18, 20 months into what may end up being a good sustained pro-value cycle. If you actually look on page 12, this looks at some of the past value cycles over the last 60 years, 52 years. And what you'd see is that there's a couple things to note. One, on average, they last about 5 years with 138% relative outperformance. But I would say even more notably is they're never linear, right? There's always ups and downs and these periods going back and forth. And we don't know what the future is going to bring. What we know is that we really like the companies that we own, and that the starting point in these valuations really are attractive compared to the market. Now, in terms of what's been going on and why some of the companies have held up well and how we think about potential recession going forward, what we really see is that when value companies and companies that are cheaper to begin with come through a recession, if you look on page 13, often they do have margin contraction in the first year that's worse than the rest of the market and compared to the more expensive parts of the market, because that's what happens, right? You have people look, and especially in 2020, right? You had all the companies that were expensive to begin with that then were perceived to not be impacted by anything or to even benefit from COVID, versus you have everyone else who was disrupted by everything that was happening. But what happened? Well, the companies that were disrupted by everything realized they had to take out costs, realized they had to become more efficient, and what you tend to see is actually those are the companies that are the best positioned to grow earnings in the coming years, because they have to figure out how to be more efficient regardless of what's going on. Right? You look at a company like Rev Group, which is a company that makes 60% of all the ambulances in the US, about a third of the fire trucks. They have a big, the E1 facility in Ocala is 45 minutes from here, something like that, right? They're really a leader in their market. They actually have a huge amount of demand, but they had tons of disruption because they can't get the chassis that they need. They can't get all the equipment, right? If you picture, what is an ambulance? An ambulance is an F-350 that instead of in the back having just a bay, right, you have an ambulance, right? Otherwise, it's the same thing as an ice cream truck or anything else. Well, when you have chip shortages, and when you have Ford making record money on every F-150 they sell, somehow they're not producing quite as many ambulances, and you have 15-month backlogs on these products. It leads to a lot of inefficiencies. That the average truck that they start to make is actually missing 40 to 50 parts by the time you get to the end of it. And they go through the assembly line, and then they go through the assembly line again. And you have two choices. You can lay off everyone, you can furlough people, or you can make a chunk of it and then have to go back through. What's interesting, they actually just decided that they're furloughing some of their ambulance, saying they went from getting 52 chassis a week to 10, when Ford said they were still going to get 50. So they just said, you know, we can't keep paying all these people, it's an issue. There are risks. They actually had, it was just an interesting anecdote as we look at the weather outside here, that back in 2020, Ocala, they tried to ramp up like crazy in July and August of 2020, as they had slowed down, there's a ton of demand, and what they found was the level of turnover when you're in a large facility that is not air conditioned, that's 115 degrees, and you hire a bunch of new people in July and August, the turnover in the first week was shockingly high. They said it's kind of like boiling a frog. You have to hire people in January, February, and have them work there for 6 months, and they don't notice that it's really uncomfortable in there. But if you start right at that time, it's a bad situation. But we're really seeing that so many of our companies have dealt with these challenges, and they're working through them, they're more efficient, and as volumes recover, they're really in a good position for that. So, you know, maybe I'll stop there and just real high level and start moving into the portfolio, unless you have any questions on how we're thinking about the market.
No, go ahead.
Okay, perfect. Maybe if you jump to page 20, this has some of our sector weights, and also just shows for comparison the Russell 2000 value, just to see where we're relatively over and underweight. And when you look at this, there's not a ton of relative change versus what you've seen in the past. What I would say is that our biggest sectors remain financials and industrials. Financials, it's really a range of, you have a number of regional banks in there, some insurance companies, a range of other companies in here. We came through a multi-decade period of interest rates coming down, where regional banks are a prime example of one where they were all impacted by the exact same challenge of interest rates coming down. But that means everyone had to reprice their business and become more efficient. We saw a range of mergers and opportunities to take out costs by combining different businesses. And really, where companies were earning double-digit ROEs even before interest rates started to tick up. And so that was why we really liked what they were doing, and feel as interest rates come up, that's just gravy. That's not something we're really putting into our models. But like the fundamental positions, and people have been afraid of them for a while. Within industrials, I would say that industrials in small cap is always a little bit of a catch-all of companies that make stuff, right? Because you have where some, like Terex, makes aerial work platforms. That's like the kind of scissor lifts that you'd see in different construction sites. That's tied to construction. But you have a range of other companies in here like Trimos, which is one that makes specialty pumps, like the pump that might go on that Purell container, right? That, yes, you can say that it's industrial, you could say it's a consumer discretionary, whatever you want to call it, but it's a lot of companies that do really a range of things that are in there. In terms of some of the others, really the areas that we have not been finding things for quite a while have been real estate and utilities, both of which on a longer term period have been really trading as bond proxies. So as interest rates came down, people were bidding up for both of those. There have been some areas that have come down. In real estate, the one that we own is Diamond Rock, which is a hotel REIT. This is hospitality. Got hit quite a bit a couple years ago. Still remains relatively attractive, but not as attractive as it has as these have come back. But so many of the more expensive stocks that were in that space, even as they've come down a bit, they're still not attractive. I will say that technology is one that is interesting because we are overweight technology, and people often think you're deep value managers, what do you mean you're overweight technology? And I promise none of these are sexy technology, right? If you look at the nature of the technology names that we own, a couple of them are distributors. So we have, for example, ScanSource, which is a leading distributor of AV equipment and point of sale barcode readers at retail stores, things like that. They're not sexy tech, but they're in a good position. They really are a leader in what they do. There's real value. And I think what's actually interesting is that we went through this long period where the value of distributors seemed to be going down a bit, where there's more price transparency, people could see the pricing and price against each other, and really in the last year plus where there's been supply chain delays, there's a lot of value of being able to actually have the products in stock that people need. And it's actually really helping a lot of the relationships that some of those distributors have, where the value was being able to fulfill things when you want them fulfilled. I'll comment on energy because this is, of course, an important one that, to be honest, has been the biggest contributor year to date of performance because it's the main sector that's up quite a bit. And it's been an area that we've been selling out of quite a bit, just in terms of rotating out of it as oil prices have gone up. And I would say that when you look at the exposures that we have within energy, on a longer term historical context, even before the last couple of years, we had been underweight for a number of years, not because we were structurally opposed to energy, but to the comment I made at the beginning of we want companies that are a leader in their market, that aren't just smaller competitors against bigger competitors. A lot of the energy names were small exploration production companies that are just subscale competitors owning a couple wells competing against multinationals. That's not a great business, right? If you look at what we did own, we had one Murphy Oil that was a larger one that fell into small cap. It was an exploration production. We've actually sold out of that in the second quarter. But then we have a couple companies like National Oil, Varco, and Technip, both of which make capital equipment that oil service companies use. So this is, when you look at all the rigs, they make the equipment that's on the rigs. Right? That's what NOV will do. If you picture Technip, and you have the deep sea drilling, right? At the bottom, they have what people refer to as kind of the Christmas tree. It's the thing that goes on the well, the blowout protectors, all that stuff. They're a leader in all that kind of equipment. Well, these are the top two players in their market. They fell to small cap a couple years ago, gave us an opportunity to invest in them. And what are we seeing? The reason that a lot of energy companies are doing very well is that the exploration and production companies are making a lot of money with high oil prices, and they're being responsible and they're not spending a lot of it on CapEx yet. But they have to. They do need to. The decline curves make it the case, and the economics of reinvesting at this price is very high. Well, these guys are the ones, they're not NOV and FDI are not benefiting from that yet, but they will as everyone starts spending to produce. So it's a slightly later cycle part of it. They're incredibly cheap even at this point, and so that just shows kind of where some of those opportunities are, that when you look at energy, you shouldn't think of it as just energy prices are up, therefore everybody's making more money, therefore you should be selling out of them. Instead, you can look at it and say, well, there's different time periods, and we're selling out of the ones that are benefiting at this point, but there's others that we're still holding on to longer. So, that's kind of the high level where we're positioned. I figured from there I might touch real quick on some of the notable portfolio actions of where we've been finding new things, exactly, which is on this page 21, where we've been selling out of. And just to give some example of what we're seeing today, and this goes through the end of March, so I'll comment also on what we're seeing and that we're getting to the end of the second quarter as well. And when you look at some of the names we've added Axalta Coatings, which what they are, they call themselves a performance coatings business. That's a fancy way of they make paint, right? You always like these companies that have fancier terms. It was, what was it? Avery Dennison was the company I remember looking at years ago. That was like pressure adhesive something something. They make stickers, right? Sometimes they use fancier words than you need to. But Axalta is an interesting example where they make paint, but they make high-end paint that's mainly for painting and refinishing automobiles and some industrial applications. It's really just them and PPG that lead in this market. And what's interesting is, as opposed to Benjamin Moore and the other paints you might think of, really there's actually a lot of engineering behind it. When you think of a car that you have, right? If you have a car that's down in Florida versus that's up in Michigan, after about a year or two, they're actually going to be different colors, even though it started as the exact same color, right? Just from the amount of sun here versus the amount of salt up there. And so it's not just you get, what is BMW blue, right? There's a lot of changes that occur, and so there's a lot of equipment behind it. You have a big stack at an auto repair shop, and what's really interesting is it's really sticky. You just use one company's paint because the whole system is behind it. You're not going to change that over. And what we're seeing now is a few pressures they're facing. That you have new car production is down. We all know that. You have miles driven is still down. And miles driven is not down as much as accidents are down because people are not driving into work during rush hour, but they're doing long road trips on the weekends. You don't get as many accidents when you're driving on road trips on the weekends. So that's depressed. And oil prices are up, which is an input. Well, what are we seeing? Well, they're dealing with that, right? It's a good business. There's only two players. They both have the same input price increases. When you picture it costs $1,000 to get your car repainted when you get an accident, what would you guess the cost of the paint actually is for the repair shop? I guess?
$350.
$50.
Wow.
That
So-
doesn't include yellow and red.
The paint total, $50 out of the $1,000 repair. And so they can raise the price 10%, right? It goes to 55, and no repair shop is saying no. No, they'll probably raise the price to you guys to get your car replaced by 10%, and they just make more money. But it's just an example of a business that is going through some pressures where they're under-earning. The costs are up, they're able to price it through, and we like the opportunity.
You just curious, you mentioned the car coating for, a car built in Michigan or sold in Michigan versus, say, South Florida.
Yeah.
Are you saying, will the auto manufacturers change the chemistry of the coating, or I'm just kind of curious.
Yeah, no, it's
Okay.
the same color to begin with.
Okay.
It's more when you get it repainted to match it after
Got
2
it.
years,
Thank you.
that you actually use a spectrometer, I admit I don't know the engineering behind it, where they look at it and they determine exactly what pigments to use,
Got it. Okay.
because it just looks different over time.
Got it.
It's supposed to be the same for a long time, and it's just not possible.
Especially if it's red.
Yeah.
No, I mean, that's
Just
the
red-
science of it, yeah.
Just red change.
Red changes more than others, yes.
Interesting, okay.
Like yellow and red.
You're saying yellow and red, yeah, or the,
The more pigment, it's like twice as much.
Okay.
Sometimes 4 times as much.
Is it really?
Red, yellow.
Interesting, okay. The other one that we've added recently is the company GMS, which is a wallboard distributor. This is the sheetrock that's all around this room. What's interesting about this one is that there's 3 players that have been rolling up the market. This has been a fragmented market throughout the history of distribution. There's real value to distribution because there's 6 main manufacturers of converting gypsum into gypsum board into sheetrock. And then you distribute it to the local houses, right? The big manufacturers can't do that. You have lots of little builders that need someone to distribute it. There's scale in being able to negotiate with those 6 big buyers, or big manufacturers, excuse me, because if you're not a national distributor and you're just in one area, there's actually just 1 or 2 manufacturers that you can deal with. Versus if you're a national buyer, you can at least threaten, I'm willing to ship this one 300 miles relative to 100 miles this way, and there's more you can do. So they've been rolling up the market, they've been adding a lot of value, and they've been putting more things onto the truck, saying as long as we have a truck going to your house, let's put some more products in there. There's incremental margins to it. And it's one where it's interesting, and I think this is useful because it hits some of the themes of what's screening up now, is that the fear is actually they're over-earning a little bit. because gypsum prices have gone up a ton, wallboard prices have gone up a ton. They mark up the costs by a constant percentage. So if you figure if your costs are up 50%, your gross profit goes up by 50%, but your SG&A, your delivery costs don't go up by 50%. So your profitability increases, right? So this is how the distribution model works and why distributors often like inflation. It's good for them. Over time, it'll be competed away. But when we look at it and we say, this is more than discounting, even if we compete it all the way next year, and you look at the fundamental demand, that's pretty attractive. And I will just comment, because Wayne and I were just talking about this last night, as we've been doing some of our screening, literally just on Tuesday, of what's screening up for our research analysts to look at. And normally what we say is that we find companies that are under-earning compared to their future, and want to find where that's going to recover. A lot of the names that are actually coming to our screening tool now are companies where the market is terrified that they're over-earning, and that it's going to collapse, and we're looking at the other way, whether it's all the home builders, right? Whether it's the RV and the boat manufacturers. There's a whole bunch of areas now that are all screening up of people saying, you know what, these are all companies that we know this is going to collapse. If there's a recession, this is all going away, and I don't want to own it no matter what. Well, you look at an RV manufacturer at 4 times earnings, and you say, how cheap does it have to be that if the normalized earnings are still cheap, and there's no debt covenants, and, then these are interesting to look at. So we'll see when we speak next where things stand, and it depends on where the market goes. But I just want to put that out there that, you know, as somewhat contrarian investors sometimes, those are often the opportunities for us to find things that everyone's saying, we know there's going to be a recession, so we know these are things you don't want to own, so therefore, why would you possibly own them?
Apply to GMS.
So GMS is one where it's a similar kind of thing. Where
Housing starts went down 3 months in a row.
Exactly, and people are afraid of how bad it could get. You know, I think the way we look at housing fundamentally is that as a country, we're still probably underhoused. We would say that non-res construction part of their business is still depressed and has not come back fully. And even if you normalize down both volumes and the profitability, it's still an attractive investment. And we like their capital deployment, where they've been buying out mom and pops at low multiples and rolling it into their business and immediately getting more value, not because they're then jacking up pricing to the end customers, which is a tougher strategy, but because they can buy cheaper. So if you figure there's 2 different roll-up strategies, right? One is that you roll up and then you say, oh, we have more market share, so I'm just going to charge every customer 5% more. That works until it doesn't work, and then invites new competition. The other one where you buy and you say, we're actually buying at a 3% discount, and when you were only earning a 4% margin, now we earn a 7% margin because we get that 3%. That's actually a pretty good business strategy. So that's part of how we've been thinking about that one. In terms of what we've been using as source of funds, we did sell out at Triple S, which is a Puerto Rican-based insurance company that was actually acquired by a Florida-based insurance company. So that was sold out of. And then really, energy, which has been the top contributors, has been a source of funds. Murphy Oil, we've since fully sold out of. We've sold out of a good portion of Next Tier Oilfield Solutions, which is an oil service company. And that's been some of the relative opportunities that we've been seeing. So I know I covered a whole bunch, being conscious of time. Maybe I'll stop there and see if you guys have questions.
I just wonder if you could give some perspective. You talked about cheap versus expensive, but I think that was fairly focused in small cap. So I'm going to ask you, what's your view on small versus large?
Yep.
Obviously, with your firm, you've got large and mid cap exposure, so you guys kind of have that kind of oversight and experience anyway. And just for the benefit of the group, the reason I'm asking, the last 12 months, small cap values 850 behind large cap value, and annualized for 10 years, it's 140 behind.
Yeah.
And typically, you'd expect small cap to be outperforming large cap over longer periods. So just kind of, what's your perspective in terms of where we are, small versus large?
Yeah, it's a great question, because the long-term empirical evidence is that that small cap, should outperform over time, all the Fama French research. And basically for the last 20 years it hasn't. We're actually at a pretty long period where small cap has underperformed large cap as just broad asset classes. And we don't think anything has fundamentally changed. Some of that is that you have a lot of mega caps that have really driven the large cap performance over a long period of time and has led to some fantastic returns. And that some of that is reversing and has been reversing recently. But we still do feel that small cap is more attractive than large cap. I would say if we went back to
It still gets back to what you pick.
Yeah, it comes ultimately down to the stock picking, and that is really the focus area of it. And when you look, there's some metrics of what percent of small cap companies are loss-making companies, right? I think it's around 35% of the Russell 2000 is loss-making companies, right? And so you have some chunk that's in there. But overall, when we look, for example, on our price to normalize earnings, and we say, where is the midpoint and the cutoff for the small cap universe versus large cap universe, we do find, I think the cutoff for small cap is around 7.2 times versus 8.2 times for large cap. So there is still some gap there in terms of relative valuation. And we do feel that it is more attractive. It's probably within 1 to 1.5 standard deviations based on the last time I looked at the data in terms of how much cheaper small cap is than large. But it's definitely been a relatively challenging 20-year history compared to the long-term research.
Thanks. Question, more observation for so small cap. I would think smaller firm, hopefully more nimble. You would expect rather than say a bit bigger firms. But again, with the environment we're in terms of financing, there's also a benefit to size as well. In terms of, I'm kind of curious, how nimble are you seeing your management teams operate? And what's their constraints? What factors maybe penalize them for being small rather than big? I'm just kind of conceptually, I'm curious. My bias is towards small, nimble companies. Okay? Call me crazy, but I'm curious. Is that bias justified?
Yeah, I would say there's two sides to that. There's one, just the financing side, where larger organizations can finance themselves sometimes more efficiently by having access to capital in different places. And it's interesting, for example, we have a company, Belden, which is they make higher-end they call themselves signal transmission. It's cables and connectors and things like that. And they have a sizable European business. They actually finance all their debt in Europe. So their cost of funds, they have no debt due until like 2027. It's all financed out for 5 to 10 years at 3.5% with 0 covenants, because it's cheaper to borrow in Europe than it is in the US. So there are companies that can benefit from that, but overall most small cap companies can't because they don't have that multinational exposure. Right. And so that's probably a relative disadvantage. You do have some, like for example, Motor Car Parts of America that deals with that. They make, they refab alternators and starters and a range of auto parts that are then sold to O'Reilly and AutoZone. And their balance sheet is actually structured where they have a receivable line that is technically backed by AutoZone or O'Reilly because those guys have a lower cost of funding than Motor Parts does. And so they can structure it in a way to get some of that benefit. In terms of the nimbleness, I would say it really depends. Overall, I would say largely yes, but the sourcing organizations differ in the sense that when you're a multinational that has manufacturing in a whole bunch of different countries, sometimes you can ship that faster, sometimes you can't. A lot of the smaller cap companies tend to be more domestically manufacturing in their focus. And so we've actually seen that it's been a nice benefit recently for many of them. So for example, I mentioned that company Trimos earlier who makes some of the pumps. They were saying that a client had said to them a couple years ago, if we're selling a dermatological cream that's FDA approved, that we're selling each bottle for a couple $100 and the pump itself costs $1, right? We just want that all made onshore. We don't want to risk any supply chain. Mm-hmm. So they built a big facility in Ohio saying that they'll produce for that specific client and have some room for growth. The number of clients that have called them and said, you're building something in the US that doesn't have to deal with Asian supply chain, we would love to get some room in that. Can we do that as fast as possible? That'd be fantastic, right? So we're definitely seeing some of that move. So to the extent that supply chains are getting more complex, that actually could benefit some of the companies that are more US centric. So I think that's how I think about it a little bit.
Thank you.
Yeah.
Any additional questions for anyone? Just again, as I unfairly asked Silchester, I'll unfairly ask you about sort of just global macro and on, maybe to start with, I mean, obviously what's occurred is the word unprecedented, I'm tired of hearing it, but it's, unfortunately, it's true. But what historical reference point would you most like in what you see we're going through right now? And then I'd like to hear your kind of, your macro views, both optimism as well as, you know, concerns, fear. Well, because everyone has concerns, but anyways, could you kind of share that with us a little bit?
Yeah, I mean, I think in terms of what we're facing now, fundamentally, what are the challenges, right? You have higher inflation and you have higher interest rates that could drive us into a recession or not, we'll see. And when we think about our companies, what we're looking at is, are these companies that can put through pricing? Are they companies that can't? And what is that time lag? And really, how do you think about the relative positioning of them during that period, right? So if anything, what we've seen over the course of the last year is some of the opportunities that we've been getting are companies like American Woodmark, which is a leading cabinet manufacturer, where they'll make your kitchen cabinets, some of your bathroom cabinets, where half of their sales are to Home Depot and Lowe's. Well, what we saw was lumber prices went through the roof, more than doubled, so their inputs went up. Home Depot and Lowe's are fantastic at dragging their feet and saying, oh, if you want to put through pricing, we have to analyze for 6 to 9 months whether your costs are actually going up. We're like, well, lumber prices are going up. We know that that's the case, right? But the profitability gets squeezed for these companies along the way. But what ends up happening is we did calls with former buyers of Home Depot who basically said, one, that's true. They always take, Home Depot is great at saying, oh, I need one more piece of data, I need one more piece of data, and just intentionally being slow. But then they give you the price increase. And two, American Woodmark is afraid to say, oh, I don't want to piss off 50% of my sales. But if American Woodmark said, we're not willing to sell to you, Home Depot would be screwed. He's like, everyone thinks that, Home Depot is the big bad wolf, but no one else can supply that much. And so they have that ability to put it through. They're now putting it through. It took a longer lag than it should have. There was a little bit of playing chicken, but this is what you're dealing with, right? Is it a company that's well positioned that can do it? Or is it a company where they're not going to be able to because something has fundamentally changed? And so I think that's kind of how we're thinking about each individual business, that our risk controls really are driven by, can each of these businesses adjust to the current environment and deal with it, rather than necessarily top-down saying, here's sector weights or sectors that are not going to be as well positioned. Goes to the exact comment I was making before on some of the home builders and luxury goods and things like that, that people are saying, well, you don't want to own those going into a recession, so therefore they should collapse. Well, maybe that's the opportunity. Wayne, I don't know if you want to add anything to that.
Yeah, I mean, I just, other things to think about just in terms of historical precedents, and we're not macro people, we're not trying to predict macro, so that's not what we're in the business of doing, but, there's been speculation, could we have stagflation come up, right? There's a period of higher inflation, slow growth, and if you look at the historical period that we had back in the 70s, early 80s of stagflation, that value actually did quite well during that period. So maybe that's a perspective to keep in mind if that's something that we end up entering.
I'm curious, when you go through your screening process, and again, I read it a year ago, it was like 40% of the Russell 2000 were unprofitable. It's like unbelievable. Maybe it was Russell 1000. Anyways, how many absolute train wrecks you see? Who would possibly put money in this? And when you come across, and you obviously toss those aside, we're hoping. But I'm just kind of curious. Are you seeing more like, oh my gosh, these guys are, hope I don't have any family working for them. So I'm just kind of curious, prospectively, intuitively, how often you see just abject train wrecks, and you're like, who's buying this?
Yeah, I mean, a lot of it, our screening tool is designed to not find those things. Those aren't the ones that are
the high leverage, right?
Yeah, whether it's that they have a ton of leverage, because one of the things we do is we do force companies to delever. We also force them to pay down unfunded pensions and big asbestos liabilities, some of that. So some of that is picked up in the screening tool.
Okay.
And then we look at what the company's 10-year average history has been as a tool. So if a company has never made money, that's not something that's going to screen for us.
Right.
Right. And so I think that, when you look at that, that's where,
They get tossed out.
yeah,
Okay.
and those aren't going to screen for us at all.
Yeah, and the valuations obviously have totally collapsed in companies that aren't making money,
Right.
all the speculative stuff.
I mean, I think part of what will become a challenge is you have, as I go through screening, pages and pages of SPACs that have, 6 months of trading history, that have 2 or 3 years of financials that are questionable financials to begin with, that are down huge, and can you get comfortable with any of these when just what's been going on in them is questionable to begin with, right? And I will actually add on that point, the other category of companies that are over-earning a lot this screen are a lot of the investment banks that have been making a ton of money from SPACs, because that's been incredibly profitable for a whole bunch of the banks, as an example.
With large cap, you had a fairly high allocation a year and a half ago to the financials. And historically, you always have, I think, Rich. Has been comfortable. Have you been,
Yeah.
I'm just curious, lightening up on the financials?
Yeah, it's been running fairly similar, about in the mid-20s, I would say.
Okay.
In terms of the portfolio.
Okay.
Yeah, and again, that's an area where higher interest rates will actually benefit them.
Right.
So,
Great. Well, thank you, I said, for accommodating all these
appreciate
it.
crazy questions.
But is stagflation inevitable? That's your question.
My question was, is there any historical reference that
There is.
so really, so there was 70s.
It's called the Carter administration.
Yeah, right.
Yeah, that would be the reference for that, exactly, right, and that was a good period
And
for
we're
value.
seeing some things right now that are frighteningly similar.
Yeah, and and I think, Evan, as you kind of listen to all of his comments, I think the point that, just in terms of what we do and how we approach it is, we're not going to try and predict stagflation. We're not going to try to predict when will inflation peak, okay, or even direction of interest rates. It'll be a matter of what are the range of possibilities, how are the companies positioned, and doing it all at the company level.
Yeah.
So that if you are in some extended period of, whether it be slow growth, financial stress, whatever it may be, that you actually own the businesses that have valuations that have already discounted a significant amount of that and have the staying power in the market position to make it through and come out well on the other end.
Great. Thank you. Any more questions before we close here?
It's back to what you pick.
It's stocks, absolutely.
That's why we have 40 to 50
Absolutely.
stock
That's what we
portfolios.
do.
Great.
Great.
Gentlemen, thank you very much, as always.
Appreciate it.
All right,
Thank you.
Very good.
It's great to see you
Good
guys in
seeing you,
person.
everyone.
Good luck going home.
Yeah, thank you.
All right. Brendan, you got the floor, sir.
Morning. We've got the May flash report for you. You probably already looked at it. The good news is a lot of relative outperformance, not only in the month of May, but also in this 2-quarter period. So just at the total fund level, ahead by 118 basis points so far this quarter through the 2 months. But of course, that is in a negative environment, down 5.4 versus about 6.5.
Okay.
One other thing that's kind of interesting to note, and I'm going to kind of focus on the fiscal year-to-date column, because that's kind of arguably the most important number on the page, at least when it comes to sort of the funding of the plan. You'll notice that your domestic equity is outperforming, fixed income outperforming, and real estate outperforming, but we do have a deficit in international, and that's really all of where the total fund level deficit is coming from. So as you move down to page 4, again, you'll start to see a lot more green than we have seen. So just real quickly, Twin, who's kind of been an underperformer for a while, is really kind of storming back, 200 basis points ahead for the last 12 months. Certainly nice to see. Barrow Hanley performing very nicely, and that's kind of your relative winner in terms of the equity space. Large cap is outperforming small cap. So over the last year, they actually made money where all of your other strategies were negative. And of course, on a relative basis, also doing well. Brown, kind of a continued story, facing that Russell 1000 growth, where the top 10 is now over 40% of the index. And that, it'll be interesting to see what happens next week when the benchmark gets reconstituted and they start doing some reshuffling, what that exactly looks like. But certainly that has continued as an issue. Zena, you just heard from, again, through every trailing period is green, so very good relative performance. And again, obviously, our expectation.
So if you graph growth and value, and, they kind of go like this, and then they go like this, and they go like this. Is there such a graph? Do we see something like that from your office at all, ever? Do we look at trying to reposition, and I know this group has never done that, I've looked at this stuff. But if you're in value, you say, well, value's doing very well. But inevitably, it's going to go this way, and growth is going to go this way when things come back to what we all liked better 4 or 5 years ago. Are we positioning ourselves for that crisscross? That's the question.
Sure. It's a good question. So to answer it in short order, the answer is no. We definitely have a value bias in the portfolio. Now, what I would back up and say, and I can bring you some additional charts and other things to support this, but what tends to happen is you've got somewhere between a 4 to 6 year run where growth does better than value, and then value does better than growth, and vice versa. So if you actually...
So Mike, as a group here, are we going to chase those crissing and crossings, or are we going to sit and hold on? And obviously you've chosen the latter, and I can see why. I don't disagree with it, because I don't think you can chase.
To make tactical allocations like that on a regular basis.
I don't think you
Just too many
can.
decision points.
Right.
Yeah. What we do is on an annual basis, and this may become a little more frequent, but we make withdrawals from the pension plan toward the end of our fiscal year to sort of bring cash into our internal funds. And, part of that is focused on rebalancing. So whatever has, returned more or gotten, performed better over the year.
If they've done well, we penalize them.
A little bit.
Yeah.
Yeah. But that's the point of rebalancing.
I'm sorry.
Yeah, no, it's good, no.
I've been a quiet member for 2 years.
No, you go right.
So you go on, because we can get to the international equities, I have some questions.
Okay.
Yeah, but I stopped you.
Sure, no problem. Well, I'll just continue on. Again, Pzena has performed very well, and DGI has also, although their benchmark is still negative, they have been fantastic recently in particular. The last 6 months, 14% ahead of the benchmark. So getting, again, if you think back 12 months ago, even when the market was still moving higher, we were looking at some relative underperformance. Not necessarily wringing our hands because we understood the strategies, but it was difficult to see underperformance when you see the market going up. Now, it's wonderful. We're starting to see a lot of relative outperformance, but it is a negative environment. So on an absolute basis, we're still looking at negative numbers, but the components are performing much better relative to kind of their individual benchmarks, with the exception of international we just talked about. So again, now slightly different from what Silchester just talked about. We bench them to the value benchmark. So they have been outperforming the core benchmark in this most recent pullback, but on the value benchmark basis, they are slightly behind. Whether that be
not even looking at the benchmarks, but just the raw numbers for our 2 internationals. Why the extreme variance?
Well, growth versus value.
I mean, why are we?
Gifford had a lot of exposure to Chinese companies.
Chinese and EM.
And that market got hit hard with the regulations.
Do we need to be doing anything about that? That's my question.
You don't want to sell low.
And I tend to think you're going to
It's
have
a discussion we need to have.
But the way I look at it, I tend to think this trend will continue for some time. It's not going to be like the COVID market where you've got, in 23 days, we dropped 34%, and then in 45 days, you recover all of that. I don't suspect that's going to happen in this environment. Part of that is just the longer nature of that growth versus value dynamic. And interest rates, unless they all of a sudden drop back down again, if they stabilize or maybe even continue to move higher from here, that continues to be a headwind for growth. And then, of course, Bailey Gifford, you add in increasing interest rate, that's already a factor. But then you add in Russia invasion of Ukraine, China shutdowns because of COVID, there's these other factors that are also impacting, in particular, the international portfolios. So I think that's why you're seeing such a huge, negative performance, in particular with Bailey Gifford, is you've got sort of this combination of factors. I think the biggest one is interest rates. Again, a lot of these companies, they have no dividend yield, there's no cash flow. You're basing your analysis on 5 years from now. And we'll just use the U.S. as the example, right? Why are we willing to buy Amazon at 35 times earnings? Well, it's because 5 years from now, we think their earnings are going to be doubled what they are today. And if you think back a year ago, when the 10-year Treasury was 50 basis points, you go out to, Amazon's earnings 5 years from now look really attractive when you're discounting them at zero, or effectively zero. Now, you take that same, even if we still think Amazon's going to grow the way it was going to then, it's still going to grow to that same level of earnings 5 years from now, but now you have to discount it at 3.5. All of a sudden that future cash flow looks a lot less valuable. And that's why the PEs are getting hammered. More on growth than in value in this particular market. I mean, there are other factors at play as well, but I think that's the biggest factor, because again, in a low interest rate environment, cash tomorrow looks just as good as cash today. Now in higher interest rates, if you've got money today and you can invest it and earn 3.5, that becomes more valuable over time as opposed to waiting for cash 5 years.
Even though relatively it's going down.
Even though
backwards.
Or
Yeah.
backwards, yeah. But I think that's kind of the ebb and flow of it. Now, strictly from an asset allocation standpoint, you'd say, well, gosh, we are overweight to value now. So if you're just following the policy, it makes sense. We can sell relatively high in value and buy in growth. But I think if you look more broadly at those trends, they tend to persist for a little while. So I would be less...
And you'd never pick the right time.
You never will, absolutely. But if,
That's
through
William's point.
annual rebalancing, we're not just sitting at a table saying, now's the time. You're just following your calendar, following your cash needs. And so this year we're a little over in value. That's probably a greater source of capital. And if next year we're still there, it again becomes still another source. And so you're working back slowly as opposed to just saying, we think today's the right time.
Relative to other municipalities, are we still way ahead of the game? When I first came on this board, we were proud of our record, and City of
It's
Gainesville
not what
employed
it used
very
to
well.
be.
Well-
We dropped a few basis points.
Yeah, certainly, if you go out to 10 plus years, the record is still intact in terms of how you stack up against other public plans around the state or certainly the country. Now, in the last 12 months, when equities are down 10% and you have a much larger share than your
Yeah.
peers, then that is a headwind. So that's,
But you can't look at it like that. You have to look long run.
We look at it
But
at
we're still-
25, 50, 100 years.
Sure.
That's what we want.
Yeah,
Yeah.
and in that range, with that optic, then you're looking at, we're advising these people well to stick with this and do what they're doing. That's where I'm coming from.
Yeah, correct.
That's where I'm just trying to understand the nuances of and you can't chase these graphs. I've tried
And no
that.
one likes volatility.
God knows I've
but,
tried it.
You know,
right. Well, and that's the thing, from a manager perspective, one of the biggest things that would concern us is somebody changing our stripes in order to chase.
Yeah, I agree. That would be bad. I agree.
Because now you're trying to drive forward only looking in the rearview mirror. And that's a really good way to get in a mess.
Yeah, that's called an actuary, but that's.
Right. But yeah, no, I mean, it's a very good question. Again, we get this, when it's stocks versus bonds, I'm a little bit more in favor of moving more quickly in terms of a rebalance. But in value versus growth, which is a bit more of a flowing trend, I'll tend to.
Well, the good news is if you get your balance right and stay with it, even though these curves do this, over time, if growth is helping you and value isn't, they'll change positions. Give it time.
Sure.
Just hang on.
Right.
Okay.
And to Brendan's point, the portfolio is more value oriented because, and part of the reason for that is because we do have such a high equity allocation. I think the committee and staff and consultants in the past have, accepted having a more of a value orientation because of that, and sort of to concede that. So.
With the exception of Twin, the other issue that I take some comfort in. Here's the deal. When equities are going well, I think as of December 31st, we're the top-ranked municipal performance plan for a decade across the nation in their database. Not the top quartile, the best performing. And that's a function of our allocation. And when we have years like this, then we drop down to, we're in the bottom 10% for a year or two, and then we come back. I think the managers that we have, which we've held for a very long time, and I think it's a testament to how well we selected them initially, they all are looking at individual companies. We don't have macro guys trying to bet is the dollar going to go down, I'm going to overweight international. I mean, they're actually looking at individual companies in a very fundamental way, which I think ultimately will probably, you control more and understand more of the dynamics of the company level than you do what the hell is the Bank of Japan going to do and just raise the Federal Reserve. So it's imperfect. The good news is we're a perpetual fund, so we have over a couple hundred years of time horizon, unlike a client that may eventually drop dead in 20 years. Okay, well that's a 20-year time horizon. Yeah, you can get in trouble there. So, anyways, but that's kind of where we are. But it's you always question when you're negative and things go bad. Is our insurance strategy be adjusted? And it's completely the correct question to be asking. I've been doing this fortunately long enough where I've seen the ebbs and flows.
Yeah.
We have no shot at meeting our assumption rates if we get really conservative. Now, we may get bludgeoned in other ways, but it's pretty much a guarantee. So it's pick your poison, I guess.
I took over a bankrupt insurance company in '84
Right.
in Jacksonville, so I know all about Jimmy Carter and his problems.
And let me kind of just add another little bit of context to this. If you look at page number 4, you actually see the market values of the different portfolios. So with Barrow Hanley, we have $131 million. And then Twin, which is core in nature, but if you combine that with Brown, you're not that far off, call it $110, $115 million. So that gap is not huge. And then further, Pzena versus DGI, 79 versus 73. So that in actual dollars, even though the value's been doing better than growth, it's not that far off. If we look up 2 years from now and we start to see real significant, the annual rebalancing is going to help pull that back anyway. But if for whatever reason value continues this run and all of a sudden that gets stretched, maybe that's when you have the conversation. Hey, on a one-time basis, why don't we dial this back in? And we'd also be a second or a third year into a value run, which means you're likely closer to that crossing back again. So we definitely would keep an eye on that and not let that get too far. But I don't think we need to jump just because it's a little bit different. Sure.
David's question prompted a thought, and it has to do with the international. And my recollection is both those managers do none or very, very little currency hedging. And clearly with the dollar being very strong, that's not been helping U.S. investors that own international stocks.
Big part.
If that reverses, the dollar is rallying quite a bit. Whether it's overvalued or not, I don't know. I understand we got the best positive interest rates in the world right now, other than maybe like someplace in Latin America, but I'm not sure I want to buy the Venezuelan bonds right now.
Let's go into Colombia.
Just a little bit of perspective on that particular issue, though. That you're exactly right. That has the strong dollar over the course of the last 10 years really has been a major headwind for international investments as you bring those back to the U.S. And you'd argue that international is cheap, but could we continue to go through this period where the dollar is expensive for another 5 years? What I wanted to mention is obviously we all know, and I have a little piece to delve into the inflation a little bit more in just a second, but I heard recently from one manager who had talked about inflation, and essentially their position was, if for a generation, the US has not had to deal with real inflation. It's been 40 years. The rest of the world has been dealing with inflation on and off that whole time. And the short version of their position was, the US is going to have a much more difficult time because we don't have any recent practical experience, where the rest of the world is going to do a better job with central banks and everything of navigating that issue. Taking that back out, essentially their point was, they think because of our inflation and maybe our ability to not handle it as well, it becomes a weaker dollar situation. The rest of the world begins to look more attractive. Again, who knows if that, but just one piece of a thought process in terms of that inflation rate and ultimately how that could impact the dollar.
Some idiot dropping a nuke somewhere changed all that.
In a minute, absolutely, could happen. Great. Any other questions on the quarterly book itself, or excuse me, the monthly book?
Loomis, with the rising interest rates, when are they going to start turning the corner? Like, are they like tied up in all 30-year bonds? Are they in short term or?
No, I mean, they're, it's called a 6 to 6.5 year duration portfolio. They're relatively constrained around the benchmark. And obviously, the last time we had inflation and interest rates really moved up was in the late 70s into the early 80s. If you think of call it 1978, the 10-year treasury, you were getting an 8% yield. And then rates went from 8% up to 13, right? Your bond performance was positive 1% annualized over that 4 to 5 year period. Well, if you're collecting an 8% yield and your final return was 1%, it means you were losing 7% a year on the actual value for 5 years. Now, transpose this into 2020, late 2020, when the 10 years at 50 basis points. If rates begin to start moving up, you don't have yield to compensate you. And so that's what you're seeing, because you're not getting yield out of the portfolio, and you're feeling the full brunt of that capital loss as rates go from 50 now up to 3.2 last week. The question is, from here, do rates continue to move higher? I tend to think they're going to be somewhat stable here in the low 3s. The bond market jumped out ahead very quickly to get ahead of the Fed. So the Fed's now at 1.5, the 10 years at 3.2. So there's another 4 to 5 quarter point increases that are already priced into the bond market that have yet, obviously the Fed hasn't caught up yet, right? They're still going to be raising through the course of this year. What I suspect will happen, only time will tell, but they started to raise rates, and we'll talk about this in just a minute, but the year, inflation, CPI, it's a 12-month comparison. So you always have to think about the beginning and end point of your comparison. As we get into the back half of this year, inflation, or the CPI, goes from 8.6, and I'm just throwing this out there as a guess, but it goes to 7.9, 7.5, 7.1, 6.8. So by the time we get to October or something like that, you've had 9 months for some of the early rate increases to start impacting the market. Inflation is coming down. Not that it's low, but it's coming down, so it seems like there's progress. The Fed says, okay, we can relax a little bit. We don't have to raise 15 times instead of the 10 times that's kind of baked in right now. And by 10 times, I mean 10 quarter points, or 2.5%, okay? So if that holds true, then I think by the time you get to September, October, the market starts to say, we don't think the Fed is going to need to go past what they originally had sort of laid out for us. And so rates will kind of stay somewhere in that low 3 range. The risk, or the downside, is if the inflation continues to run at 8.5 or even higher than that, even though we've had all these months of comparison, then the market says, okay, instead of 10 increases, maybe it's 14 or 15, and then you have another leg up of rates. The good news is now your fixed portfolio is yielding 4%. So you have at least some yield to compensate you for if that next leg happens. So again, I'm not anticipating great returns out of fixed income, but I think it's going to be marginally positive because rates kind of settle out for a little while.
Marginal positive, better than negative.
Yeah, well, but part of this is you also, quite frankly, saw this coming. Said we aren't getting any yield, and we think rates are going to be higher, so you have under allocated to fixed income. So even though the percentage
It's like
losses
5%
are
or something.
right, it's 4.2. It's you have minimal exposure as compared to, again, the average plan out in the state of Florida has 20% allocated there. So from that standpoint, it's certainly a benefit. And again, as a reminder, what we really did is we put that estimate as 1 year worth of pension payments. That was kind of where that dollar value was set. So if equities went completely
Is it still there,
sideways,
Is it still there?
Yeah.
but that again, the idea is if equities, worst case scenario, where equities drops 50 or 60% in 1 year, you don't want to be a forced seller. You have a year's worth of benefit payments in fixed income that you could utilize, to.
And it's just gonna be interesting, because just like how many people in the United States were here 40 years ago saw what it could be. It's gonna be a huge shock.
It is. It will definitely be an issue, but I think that's why the equities have, a big part of why they've sold off the way they have. It's the market essentially pricing in recession.
Brendan, I haven't had time really to keep up with the Loomis sales portfolio and their trading activity. What would you say their turnover is? And the reason I ask is, internally, we buy bonds, or we've started buying bonds again for a few years. We had some leadership that wanted to focus on more or less money market investments for operating fund cash, but I've started buying bonds again. And, I'm less concerned about the market unrealized loss from market value deterioration because I'm going to hold the bonds to maturity.
Right.
So it's all going to come back. We may have to do financial reporting that shows unrealized losses on market value, but when you've got a manager like Loomis or a mutual fund, a bond mutual fund, you don't control what's bought and sold, and so you actually start realizing losses on trades maybe.
Right.
Are they, would you say they're more likely to just hold on to their bonds and eventually recover that, or are they constantly trading in and out to try to get a better?
I think it's more of a mix. So in some instances, in some areas of the market, they're going to just hold on if they don't see that relative value. But even if you've got a bond that's obviously trading down at a loss, but for whatever reason, whether it's in the mortgage space or whether it's in a corporate bond, you see more opportunity elsewhere.
Right, they'll do that.
You'll realize the loss to move to another security that either gets you the yield or the duration that you're looking for.
Right.
So it's not so absolute that it's really just that, oh, we're at losses, so we'll either capture or not capture them. It's more just that relative value in terms of
Just trying to reposition.
reposition based on what they think.
I think the bigger risk is significant net redemptions. Where a portfolio manager, people are just flooding out of the fund, and they're a forced seller. They're just trying to figure out how can I sell this afternoon to beat redemptions. That's where I see these bond ETFs and bond managers, stressful environment. That's where they have no choice. They're selling at a loss at the market. Everyone on the other bid side knows it. They're tearing their face off in terms of their pricing. So I think more importantly is tracking. If they're basically their net flows are relatively stable, out of risk, if all of a sudden there's a huge run at Loomis sales on by redemptions, that's a little more, that's a dynamic that the portfolio manager can lose control very quickly with pricing. So.
And what happens too is in a crisis period or a stress period, if that is the case, you need liquidity. You may lose some of that liquidity in your corporate bonds, but you have it in your agencies and treasuries. Right. So then if they're forced to sell and liquidate quickly, then you end up with a portfolio that starts to have a growing amount of corporates and other illiquid securities, right. Which, again, kind of creates a little bit of a deviation from the type of portfolio that you had. Again, we don't see that, but it's certainly something to look at more carefully, and we can talk about that.
Just curious.
Yeah.
This is all very good discussion. Thank you for it.
We talked about inflation, and I just wanted to hand out this chart.
Yeah,
It's
very
more
good.
or less self-explanatory,
Yep.
but I just thought you might find that interesting to see kind of, again, the year-over-year comps, what's included or what's excluded when they talk about, CPI, and then they exclude food and energy. What's interesting is that's only 22% of CPI, but then if you look at, kind of the other 78, I won't speak for you, but I look at the list and I say, I think 80% of my spending is in that 22% that's in, the food and energy, and very little of my spending correlates to the 78% of CPI.
Right.
But again, that's not for me to decide, that's the Department of Labor that does that. But again, I just thought you'd find
It
it
doesn't make sense to me either.
interesting.
I had my first $130 fill-up.
And then the last item, again, I'm not going to explain it, it is just the most recent updated the drawdown chart that you've seen 15 different times. As painful as this has been, it is still just a relatively small blip there in the upper right-hand corner. Still, 150% above the COVID lows. So as painful as this is, we're still in a very good spot compared to just 2 years ago.
I might make just an
Yeah.
observation to sort of contrast what we see in this portfolio with our allocation to our police and fire pension plan. We had that board meeting yesterday, and Harvey's on that board, so he's aware of what I'm talking about. But we've got a consultant on that plan, Willis Towers Watson, whose focus is, I think, more on corporate clients than public pension plans. And they've that board pays less attention to staff than the committee does here, and they tend to listen more to the consultant. And I have some fundamental disagreements with that consultant, but there's not a lot we can do about it. They have sort of maneuvered the portfolio into a more or less 70% equity and 30% what they would call income sleeve or income segment. And within that segment, there's probably 15 or so percent in real estate, some core, some niche that's not doing so well, and maybe 4 or 5 managers of what they call alt credit, which is either high yield or asset backed, securitized. There's one that does like short-term renovation loan, 1-year loans to house flippers, that sort of thing. And the whole point of that segment, according to the consultant, is to try to provide something like an equity, a low equity type yield, but with lower volatility. Their whole focus is lower volatility. I don't believe in that portfolio, but again, I can only voice my opinion to the board, and they do what they want. But as an example, we've kind of had that income segment develop over the last 3 years or so, and in that time, we've had several managers blow up. We've had turnover of probably 6 managers in that income segment, particularly all credit, over a 3-year period. And to me, that's ridiculous. That's a very poorly managed portfolio if you have that much turnover and that many problems with the managers. And you don't see that. My point is, you don't see that in this portfolio. We're pretty straightforward, vanilla equity, some fixed income, and some core real estate. And I think over the long term, that's the type of portfolio that makes sense.
I don't look that point yet.
And then if you could, before we wrap up, and I know I appreciate everyone's time today, so I know that the finance arm of, the Board of Trustees met last week. Well, and I talked a little bit about it. Appears they didn't pay any attention to what staff had presented to them, and they completely disregarded our recommendation to try to influence the portfolio strategy with regard to Russian and Belarusian securities. William, could you just give us a quick update on
Sure.
what they've...
And, in hindsight, I sort of made the assumption that the commissioners would read the material, and I probably should have walked them through it a little more closely. But I'll adjust that for upcoming items. But they had passed, the city commission had passed a resolution back in March, which requested the boards of trustees for pension plans and retiree health fund
Yeah, we've seen that.
to consider, directing staff and investment managers to divest of all Russian and Belarusian securities, and then also to update investment policies to restrict investment in companies from those countries. We drafted a PRC memo, at the committee's direction, because the committee wanted to voice their opinion against those recommendations. Like John said, the commission pretty much ignored that, and also ignored, a fiduciary memo from the city attorney's office. But the next step that staff will do is we're going to look at the investment policy statement, because now we're required to do that by the board. We're going to draft some language that we think meets what they requested us to do. We'll probably try to balance that with what we think the way it should be handled, to put some sort of modifying language in there. And then that will go back to, we'll probably try to take that back to the Board of Trustees, the City Commission sitting as the Board of Trustees in August. But we'll let the pension review committee take a look at it as well, and see what you all think of it.
I was planning to be at that meeting, something came up early that morning which precluded my attendance, and now I really wish I'd been there, because it's...
Well, the whole...
Doesn't sound like you make any difference.
we
Maybe not,
Oh,
but
okay.
Uh-huh.
I don't have to worry about getting fired by the city commission by stating the obvious, unlike some staff
Yeah,
members.
yeah.
But
Well, in the timing of the agenda items has been a little bit volatile lately. Typically in the past, if there were an item like this, a resolution, the clerk's office would just, and I thought this would be addressed in April, and I thought the clerk's office would schedule the board to meet because they have to do that. And there's some, I don't know what the issue is really, but they came back and said, well, no, the city manager's office has to request us to do this. And they, to me, having a resolution from the city commission should supersede, any request from any other charter officer. But we're still working with the clerk's office to resolve how we get these agenda items to the board when they need to meet to discuss them. My point is, this should have been addressed in April, and it might have been easier for John to attend and that sort of thing, but it got put off, and then all of a sudden it had to be done in a week for some reason, but that's local government. So anyway, we're working on it.
the next larger battle is, some of the commissioners and our trustees want to put an ESG screen on some of our portfolio. We've talked about that. And it's a clear violation of ERISA rules, and our city attorney's been very clear that they're walking a very dangerous area that hasn't really seemed to bother them in the past about certain things. But
No, it doesn't.
we'll see what happens. But
So-
I'm not happy with the leadership of the
So
Board of Trustees.
that discussion is still taking place in a city commission subcommittee, the finance committee, which consists of 3 city commissioners. We met last month, and I provided them with a presentation, a staff presentation recommending against ESG and SRI mandates for a number of reasons. The city attorney also provided a memo reminding them of their fiduciary duty and saying that this that could lead to legal action, and it was really could be considered a violation of their fiduciary responsibilities. At that meeting, one of the commissioners agreed with the city attorney and was ready to drop the issue. Another was sort of non-committal, and the third wanted to press forward and get more information at least. So what staff has agreed to do is go back to this committee. It meets again in August, and to get information from our existing investment managers on what type of ESG factor analysis they do in their investment decision processes. And we hope that when they see that, I think pretty much all of our managers have some evaluation or criteria that they consider. And our staff's point was, you don't need to make a mandate or put this in an investment policy statement because our managers are already addressing the issue and evaluating
That won't
companies.
help them, they want the trendiness of it.
Well, we'll see. We're going to provide the information in August to this subcommittee, and then we'll see where it goes from there. For any action to take place, they would have to refer an item to the full city commission, and then the city commission would have to refer it again to the board of trustees.
Very good. Well, thanks for that update. There are no other agenda items. Any more comments or issues to be brought up? If not, I'd entertain a motion to conclude the meeting. Do I have a second? The meeting is concluded. Again, as always, thank you everyone for your participation.